start with defining your investment goals and in terms of money you are willing to, I'm sorry to say, but lose, because you could lose money in any type of investment, and look at your time horizon for needing that. Are you betting on this investment to provide you cash flow to pay your bills? Then no, that's not a good idea.
Welcome to the Contrarian Capitalist Podcast, the ultimate destination for accredited investors and entrepreneurs seeking alternative wealth-building strategies. Discover how to fast-track your journey to wealth and time freedom by thinking outside the box. If you're ready to join the ranks of the Contrarian Capitalists and learn the most effective ways to reach your financial goals faster, you're in the right place. Let's get started with today's episode of the Contrarian Capitalist Podcast.
Thank you once again for joining another episode of the Contrarian Capitalist Podcast. It is I, your favorite silverback, Sylvania Harrod. And on today's episode, I went out into the market and found a person that I would consider another silverback leader. And that is my friend, Sandhya. So, Sandhya, nice to meet you. How are you today?
I'm doing great. Thank you so much for having me on your show, Sylvania. This is amazing. I just love and respect people who put out so much great content to educate others about this space.
Yeah, absolutely. So if you don't mind, let the audience know a little bit about your background, because I know you have a very unique story that I really connected with when I reached out to you.
Thank you. So like a lot of immigrants, I came to the United States with 2 suitcases in hand to be a starving student with a scholarship. $8 a week was my food budget. So it was back in the day. Uh-huh. So I knew all about couponing and saving money, etc., to make ends meet. I had a couple of part-time jobs on campus as well. But luckily, I got myself a nice engineering degree in the Dallas area and then got hired right away off campus to a job that put me in corporate America for over a decade. The company was wonderful. I realized very quickly that as much as we engineers like to geek out and make the best possible circuits we could, I'm an electrical engineer, I realized that it's these marketing and sales kind of people who make all the decisions and who also seem to be making all the money. So I really wanted to understand how they evaluate businesses. How do they analyze these things? How do they go after different markets? So my company was kind enough to pay for me to get a part-time MBA. And that's where I got all my investing brain, the product, pricing, plays, promotions, all the basics of understanding how, it's not just, okay, this cost me $10, I make 10%, and then I go sell it for a profit. No, it's what is the perceived value? How does it change their life kind of thing? So that opened my mind to investments. And after about a decade in the company, I realized that my investment income, just from belonging to different stock clubs and trades, etc., was just as much, if not more, than my base salary in my engineering job. And so that sort of was a big aha moment for me. By that time, I also had kids. And so I was able to quit corporate and transition completely into an investing world where I would trade for just a couple of hours and then spend the rest of the day with my kiddo. And I actually was full-time raising my kiddos, which was a very nice feeling. And the intellectual side came from stocks. But then I had a tax problem. You see, my husband had a W-2 to give us all the benefits and stuff. And I was now making money with stocks. And that's where I stumbled upon commercial real estate. And I got into multifamily syndications because I didn't have a background of fixing leaky toilets and laying my own tile and painting and all of that handy person kind of stuff. That's not the background in which I grew up, but I know my spreadsheets and numbers. So when I got into multifamily syndications, I'm an asset manager, and we employed third-party property management to handle all the day-to-day tasks, so for repairs and maintenance calls and everything. And that was a good fit. So I did that for several years. And lately, I've also pivoted into other asset classes because real estate got hammered with these rise in interest rates since 2022. So I've been doing oil and gas. I've been working on a technology fund while still managing my existing multifamily deals. So that's where I am today, an entrepreneur with a variety of assets, trying to copy, the portfolio of millionaires and billionaires, right? They never put all their eggs into one basket. And I think that's very important for people to realize.
I think the thing that I was most made aware of, especially when I started hanging around like centimillionaires and above, was just how little they actually put in the market other than like what they were getting from different companies and however it was structured on their equity side. and what was kind of like the diversification strategy they had in general. And so that was so surprising to me, because I go, oh, you're telling me like you're saying 60% of your assets is in private equity and private credit? Holy smokes, like, and then you start looking at math, and you go, like, me being around engineers, I like to say I have an engineering mind, where it's like, I'm just going to reverse engineer what you're doing. So even what you're saying in your book is not actually what you're doing in life. That doesn't make any sense to me. And so just listening to your story about like that aha moment when you woke up and like, hang on, I'm making this money here, I'm having kids. What was it like, that moment when you actually made the choice to like resign and go home full time? What was that like for you?
So the job was definitely demanding more and more of my time. And it got to a point where I would start missing milestones with my kiddo. Like, I would have loved to have, taken time off to go participate in, let's say, a school activity. I'd have to get permission. The vacations were getting harder. I only had a limited amount of time. And I realized that the job wasn't as fulfilling as it used to be. When I was single, it made all the sense, corporate was my life. That was my social circle, the trade shows, the travels, everything made sense. Now my family was tugging at me, and I realized that with stocks, I spent much less time and got pretty much the same results or better results. Luckily, the stock market cooperated, but I know how to trade betting on the stock market going down, which is what we call the put options. It's not always a call option, expecting the options, the stock to go up. So I learned all of that in trading. And so that was definitely more profitable. So that was my big moment to realize, why am I doing this? Why am I spending this many hours and being so stressed out when I could relax, be with my kiddo, raise my kiddo the way I wanted to raise them, instead of leaving it to a daycare and influences? And so that was very powerful.
No, I love that. I've always referenced it as the hustle to reward ratio.
Exactly.
When I actually looked at, I was like, okay, let me look at the math.
And
in
so
order
that
for
was very
me
powerful.
to keep climbing the ladder in this structure that I'm currently in, I'm capped at what my max earning potential is based upon the role I'm at, depending on compensation plans or how it is structured against you. So I can work 30 more hours for a possibility of a 15% increase in income.
Yep.
What is that math? That math isn't mathing. Versus I can have the opportunity to where I can work the same amount of hours, but my reward is 3-time-fold. But the autonomy is even greater because I'm building something for myself. Did you have the same kind of aha moment as you were evaluating that data?
Exactly. The ROI on my time, but also the freedom of schedule. I could choose to spend 10 a.m. with whoever I wanted, doing whatever I wanted, instead of having to be stuck in a meeting or, hey, customers in town, guess what? Your evenings are gone because you're going to go to those dinners and all of that kind of world, which was fun for a while. But now there's my why changed, You always want to go 5 levels deep on your why. Why are you doing this? So why are you doing this? And if you ask yourself that and get down to those fundamental conversation at least once a year with yourself, then you can kind of decide, is this the direction I want my life to take? Because if you keep doing the same thing over and over, you can't get a different outcome. You've got to actually make a change. And 5 years from today, you'll be in the same place wondering why you didn't try something else. I knew I could always get back to corporate if I missed it. So I had that confidence, I had the connections, I had the experience. So that was never going to be a problem. But if I didn't take that shot, I never would have known what it could be like. I had never experienced a world beyond corporate at that time. So it was important to take that chance. And so I have reinvented myself like at least 3-4 times now in terms of careers and what I do and what my priorities are.
Yeah. Listening to what you're saying, there's the only constant in life is change. And the quicker you can accept it and absorb it and just keep running towards your North Star is the more fun life is. Yeah, and you're also spoken like you've invested in yourself. Yeah, because most people that I find that are zoo animals, they don't have the language that you're using. So like, how big has personal development been for you?
It's been mind-blowing. It's like each time you get rid of these limiting beliefs, as Tony Robbins tells you, and I've been to several Tony Robbins events and certainly read books by other philosophers, but like Stoicism by Ryan Holiday, Robin Sharma, Mindset, and etc. James Clear's books, on atomic habits, etc. It just completely changes your perspective. You don't have to be perfect to get started in something. That's a very important thing. A lot of us chase perfectionism. We're afraid of looking stupid on social media, so we don't put ourselves out there. It's like, what's the worst thing that can happen? Guess what? People don't remember anything. Whatever you posted last week, people have already forgotten. They're too self-absorbed. Everybody's distracted. Everybody's, completely addicted to their phones. So nobody's going to remember. And you got to remember that nobody cares. Nobody's going to remember your post from last week or the outfit you wore for the last podcast, as an example. Nobody cares. So remember that. Just go be authentic and true to yourself. And the better you get, it's like Jim Rohn says, right? The more you spend developing yourself to become another person. And this is what I tell my kiddos, like, why are some kids the cool kids and you feel like you're not a cool kid? Well, what is that cool kid doing? Well, maybe that cool kid is the best athlete in your football team, or plays drums better than anybody else, or is, buff like nobody else. Well, they've put in the hours. They've put in the time. They've trained for it. So go become a better person, evolve, and you will attract those right people to you. That's what happens. And the more you realize that, the more you focus on becoming a better person, because then I'm going to be more available for my family. I'm going to be a smarter person in seeking the right investments for my clients. And overall, I'm going to be a better spouse, and I'm going to be a better person in my communities where I want to improve these apartment complexes. I want to leave it a better place than when I found it, when I acquired them.
What's unique about what you're sharing is that, like, I've always communicated with my children and with friends and family members that we live in the residual of our thoughts, beliefs, and actions. Mm-hmm. So whatever we're sitting in today, or whatever conversations are showing up today, is because that's a residual effect of what happened, of what decisions we made, beliefs we're holding true, and actions we decided to take. And when I look at that formula of what you just shared in that moment, it's a thing of beauty, because I can understand why you're experiencing success in life, because just hearing the language is the number one way I can identify what's happening in somebody's unconscious. And so the language and the terms and the flow that you're using is something that makes you unapologetically you. And I just admire that.
Thank you.
So I can tell the amount of depth. It's no different than, like, if you see a person that's in a certain level of fitness, especially if they don't have youth as their advantage. Mm-hmm. Like, when I look at it, I go, yeah, you definitely put in the time. Mm-hmm. Like, you definitely go through the motion. You're willing to embrace that level of discomfort that created that muscle that happens to go there. Me being a sports guy, those are the things I think about. But one of the other things that attracted me to you to have this conversation was you were talking about a topic that I don't hear most people say. So one of the things that I despise, knowing marketers, so there's the beauty and the ashes side of it. The ashes side of it is there's people leading people down wrong paths, where they're like, you should go do this thing, you should go do this item, without giving them data of, like, factual data of what they're doing themselves. And so when I look at that, I say, I saw you talking about oil and gas. And it wasn't until I was talking to my tax strategist and he was just sharing with me, like, what's happening on a depreciation element. I'm like, hang on, what? Mm-hmm. Like, I had no idea. And I'm just having the conversation. So to help the audience understand better, because a lot of them will get RSUs or they'll get large commission checks. And I look at, like, your blueprints determine exactly the decisions you make. So protect yourself from yourself. So if you had a person, let's just use this for math's sake, they're about to receive $100,000 in like cash that's coming in. If they were to go park that on oil, tell me why you love oil and gas, but and use that number as to, like, help them develop and understand what type of returns they could expect with that $100,000 number.
There's three main benefits I like about oil and gas. And the first one is that you get a tax write-off, 80% right off the bat, as a K1 paper loss in your 2025 taxes. So if you put 100K into an oil and gas deal with me today, and we structure deals differently, so you have to look at how every person structures their deals. But our deals, we structure it because our investors want that tax break. And a lot of them are W-2 engineers. So they do not have a real estate professional designation. So for you to get those benefits in real estate, typically you have to have that REP designation by the IRS. In oil and gas, if you put 100K into my deal, you will get a paper K1 loss statement that says minus 80K right there. So if you made, let's say, $500,000 this year, instead of 500K as your annual income, you get to reduce that to 420K because you're taking off that 80K from my K1 that I'm giving you on this oil and gas deal. So if you're in the 33%, let's say tax bracket, that's like almost 27K in savings for you. So your 100K investment today in April of 2025 is going to give you an immediate ROI of 27K saved in your 2025 taxes. So that's an easy figuring. The second thing I like about oil and gas is once we have everything in production, after about 4 or 5 months, you start getting monthly distributions. So every month you get a check. That first check will be a little chunky from the first 4 months of production. Then from month 5, it becomes more of a steady state. But in 24 months, roughly in about 2 years, assuming a crude oil price average around 70, today it dropped a little bit to 65, 66. But on average, if you say over that 2-year period, if it stays around 70, you should get all of your invested 100K back to you in 24 months. And then after that, you should be able to get an additional 100K in the next 2 to 2.5 years. So about 4.5 years into this investment, your 100K should have come back to you as 200K. And then let's say we go up to 7 years, you should get back another, 75 to 100K. So between 2.5 to 3x your money in 7 years is the projection. All of these are projections. And then there's not really an end. It sort of trickles down. Your wells produce the most amount of oil in that 0 to 6 year time frame. And beyond that, it trickles down. So even 20 years later, you might get a $100 check, but you're not really counting that. So you can kind of write off that investment as I'm kind of done with it at that 6-7 year mark because you've more than doubled your money. But the benefits that my investors like is that you get this tax write-off for non-real estate professionals, anybody who's a full-time W-2 income person with RSUs from NVIDIA kind of, paychecks, they could benefit from it. And there is no recapture. You see people talk about 1031 exchanges in real estate. Well, as soon as one deal sells, they have to run and chase another deal so that they don't pay a huge amount in taxes from what's called recapture that comes back to bite you a few years later. You don't have that because all the money here has been spent on drilling costs and other expenses. There's not a building still standing 5 years later for you to recapture that. And so that makes it very attractive. It's tax benefits year one without ever having to worry about recapture later and can be used against any income. You made money in the stock market? Great. You made money from your W-2? Great. You can apply it to all of that. You don't have to be full-time real estate like me to get those tax benefits. And that's what makes it a compelling investment. Now, the biggest risks that you don't know, the biggest unknown is you have several wells here that you're investing in, the rights, the mineral rights, and the drilling of those wells. But you don't know the quantity of oil each well is going to produce. That's why we never invest in just one well. We at least invest in a group of wells, and we only invest in locations backed by humongously big companies, your Exxon, your Chevron, your EOGs. We only have huge, big operators drilling. We don't go to mom and pop shops. So we are actually not the operators ourselves. By rights, mineral rights, and the rights to, a piece of that profit. And we only get into deals after the drilling has started and oil has been found in those wells. So just like in real estate, I don't do brand new construction in an empty land somewhere. I go by existing cash flowing properties because that minimizes my risk. It may also reduce your profits a little bit, but that's the risk that we're willing to handle. So we want to only buy wells where the drilling has started and there is oil. Now, the quantity of oil is an unknown. The crude oil thing is an unknown, but you kind of do what we call a break-even analysis to know, okay, if crude oil price goes below $37, we're going to be having to lose some money. So we will accordingly reduce our production and reduce your operating costs because I don't want to be selling it at that price. I want it closer to my 70 for it to be sold. So that's how you restrict the supply of all these big companies, not me. I'm so tiny. I'm such a tiny little speck out there relative to these huge companies. But I'm telling you how they work is they start reducing the production when there is that much of, crash in oil prices, which had happened during COVID. But it only happens for a short amount of time. You control the supply. And then when prices go up, you produce more and you make more money. So you want to look at an average price, just like you want to look at a property. You want to look at its financials over a quarter rather than day to day. With oil prices on average, you base your projections on that and what are the assumptions. And so understand the risks, understand what you're willing to tolerate in terms of risk, and the rewards could be favorable provided that meets your goals. And so for my investors, this is ideal if you make a lot of W-2 income, stock income, you're looking for a tax break, you don't need the money immediately, and you're okay with getting monthly distributions after 5 or 6 months. And sometimes that's going to fluctuate depending on the oil prices.
It's true. I mean, in any asset, no matter what you're looking at, there's always inherent risk to go through things. I mean, there's risk of putting money in the stock market, right?
Yeah.
Like we said, S&P's down 10.5, so you're late. So like, there's always inherent risk, but it's, you have to balance, and you create structures that help offset that risk. And the things that you were detailing are all the key points that people, like if you were listening to that, go back, rewind that, take notes, or use the plugin that goes ahead and transcribes it, put in your ChatGPT, and just make that as your measurement of what you're doing going forward, because you have to understand, how do I mitigate my risk? And that's the reason why I fell in love with funds, is I realized that like, if I poured into one asset, in that one asset, and this kind of happened to a lot of people. I talked to different developers across the board. The old adage was, all I'm focused on is things within that I can touch and see, like around the corner from me. And then they realize there's inherent risk when you just acquire assets that are 5 minutes from, because what happens if it's just the same thing? If something hits that area, everything goes down. But like, if I'm in an area where it's like, if I had all my assets in that one county in California that could create all the fires, all my assets are gone. But if I have things in California, I have things in Nevada, I have things in Arizona, I have things in Texas, Florida, it creates a diversification, and you spread the risk as best as you possibly can, which was the whole concept of why index funds began with to begin. So like, super intelligent process. You got to know your buy box of things you're looking at. But the other challenge that I see that a lot of the different audience members are at, which you had touched on before, but I want you to like double click on that, is they're sitting on the fence from a space of paralysis through analysis. They're a little bit afraid. What would you share to that person who wants to, like, they know they want to go out into the jungle, but they're a little afraid of going out there? What would your piece of advice be to them?
I would say start with defining your investment goals. And in terms of money you are willing to, I'm sorry to say, but lose, because you could lose money in any type of investment. And look at your time horizon for needing that. Are you betting on this investment to provide you cash flow to pay your bills? Then no, that's not a good idea. So I always start with having 6 months of living expenses. I model what's my break even. Like, let's say if I lost my job and my primary source of income tomorrow, what do I need to have every month to cover all my basic living expenses? I may have to cut that country club membership or other fancy things you might be doing, but what do I need to basically live the standard of living? What is that number? Is it 10K a month? Is it 5K a month? Whatever that number is for you. Take that number and make sure you have 6 months of living expenses saved somewhere that you don't touch, like in something as safe as, I don't know, treasury bills or whatever you want to call it. Then you look at your rest of your portfolio. And I'm just going to use $1 million as a number, because a lot of people, if you worked for at least 10, 15 years, you probably have that amount in your 401k somewhere. And if you have 401k money like that from a previous employer, you can roll it over to do these alternate investments. So that would be like, real estate, oil and gas, etc. You could use it through either a self-directed IRA or a solo 401k if you qualify. But there's other ways by which you could write checks with that 401k money. For me, it's money I'm not counting on in the near future. It's money that I can wait another 10 years to withdraw. So that's the kind of money that you could use to invest and really find you can make asymmetric returns on that. Because a lot of people don't realize how much fees their fund managers are charging them and how many trades they're doing to make money even within their fund. Like they might have a 2040 retirement fund or something, which is 15 years away. And you should look at the fee structure of those funds and the number of trades they do and how much money they make in each of those trades. And so you look at that versus, okay, if I have $1 million portfolio that's going to hopefully multiply for me, can I take maybe 50K and 100K, et cetera, and put it into a variety of investments? What about that shopping center down there? Somebody's making money off of that. What about that small business there, that laundromat, that car wash that people are making money? So look at the portfolio of billionaires. They are divested into a variety of different asset classes. They're not putting all their money into the stock market. So same way, does oil and gas make sense? Go and look at the risks and the rewards and see if that makes sense for you. And set yourself a deadline. Today, let's say, is early April. By the time the show comes out, give yourself a month and list all your questions. These are my 15 questions I need answered to make a decision on, let's say, oil and gas. Get those questions answered. So at that end of that month, you know, is it a go or a no-go? Okay, I'm going to not go with this investment. Let me go learn another investment. Okay, another 30 days, I'm going to learn everything I need to learn about investment B, and then make a decision. Because if you don't set a deadline, you will drift. And a year from today, 5 years from today, you'll be in the same spot wondering, oh, should I have done that back then? So no deadlines, nothing on your calendar. It's probably not going to happen.
It's completely true, because if we think about it, like if you're listening to this episode, you probably have already spent at least 2 years of information of like studying and watching and following the trends and seeing the information and knowing you should be able to do this. We're all adults. You know, it's like we've all spent, we're getting close to 20 years plus in whatever industry we're in. And so you got to ask yourself this question of like, if I keep doing what I've been doing, I'm going to keep getting what I've been getting. So if you really want to make a choice, and as you mentioned before, like you just tell them, like unless they fundamentally change the actions they're doing, nothing's going to change. And you're going to be in the same situation, and you're going to sit in a pile of hopes and dreams and one days and some days, and you're going to be looking at the calendar and be like, damn it, I didn't do it. So take Sandhya's advice. Go do it. Audit yourself. Audit the actions you're taking. Audit the thoughts you have. Audit the beliefs you have. And just get to clarification, because what you'll find out is that a lot of the questions you have are smaller, are easier than they are, and your brain has just created this void into the actions you can be able to take. And so, Sandhya, if anybody's listened to your information, they want to reach out and connect with you, how can they get a hold of you? Where should they go?
LinkedIn is the best place to connect with me. And please mention that you heard from me from this show. And I post a lot of little facts in there. Like, JP Morgan is predicting a shortage of 7 million barrels per day by 2030 in oil. 80% of the world's energy is still from carbon fuels. And Warren Buffett, our hero, has basically put in millions and millions, hundreds of millions into oil. In fact, it's one of his 6 of top 8 picks of his stocks that's permanent in his portfolio is oil. So it's not about whether you're environmentally friendly or not. Oil has so many uses beyond fuel. It's in plastics. It's in so many other applications. You can't live without it. So realize its importance as an example of an asset for you to get into. Yeah,
I love it. So as you can see, if you're watching this on YouTube, you can see the link below. If you're listening to it, it'll be in the show notes to find her on LinkedIn, have conversations, have discussions, and be curious, my friends, because what you'll realize is this stuff, like once you understand the basics, it's just a matter of like understanding yourself, understanding your risk profile, create a little bit of diversification. She gave you the strategy and started talking about self-directed funds that you can be able to use. This is money you're not even counting on right now. Not something that's what I refer to as like your nut, like what you need in order to survive. Like, so the perceived risk is actually less than what it is. But Sandhya, I love this conversation. Thank you for sharing all this information. Anybody that's listening to it, as always, stay hungry, stay humble, and stay grateful, my friends. Cheers.
Thank you so much.
You're welcome.